Hey everybody, today we're talking to Nelson Knight, president of Apple Hospitality REIT. Everybody knows Apple, they're a big player in our industry. But I wanted to talk to them because they're a publicly traded company and therefore have lots of publicly accessible data that we can dive into. Wanted to ask Nelson a bunch of pointed, candid questions and see if he'd be honest with us. The questions obviously are: what's the solvency? What's the liquidity? What do you plan to do with all your cash? And what issues are you having today that maybe we can learn from? Hope you enjoy it. I did. Thanks. Nelson, how we doing? Thanks for joining me
Hey,
today. I appreciate the time.
hey, it's great to be with you, Teague. Appreciate you inviting me on Teague Talks.
So, where are you? And you're looking great. I like the sport coat.
I appreciate it. Thanks, man. You like the home done haircut as well? So
Is that
still haven't
for
gone to a
yourself?
barber. Yeah, it's a joint effort between my wife and myself.
Good for you. So, where are you? You at the office? You at the house?
So I'm at my home actually today, working from home. I've split my time between the office and home, but spent the majority of the time in the office. But today just felt like a good day to be working from home.
How
It's
are
nice
you?
weather outside.
How are you as a homeschool teacher?
You know what? I am not a great homeschool teacher. I have four little kids, including one that's going to be going to kindergarten next year and is trying to learn how to read this summer. And yeah, let's just say I am grateful that I married up, and my wife is doing a fabulous job in their instruction. So fortunately, I don't know when your kids get out of school, but my two older kids got out of school this past weekend and are ready for summer break.
All right, so let me dive into the portfolio and the COVID impact, because that's the other questions everyone has. So if my stats are right, you guys currently have 233 hotels, over 30,000 rooms in 34 different states, 87 different markets, and 12 brands. So you got a lot of diversity. And I think that's part of why we wanted to talk today. Everybody knows who Apple is in our industry. You guys have a lot of different hotel types across the country. So we'd like to hear what kind of impacts you're having. So maybe start with what kind of impacts you're having, but what kind of closures did you have to do at the peak? What did those numbers look like, and what does reopening look like?
Okay. Yeah, happy to talk about that. As we look, Teague, one of our corporate strategies and pillars is to be broadly geographically diversified. We're the largest, as you mentioned, 233 hotels. That makes us the largest select service publicly traded REIT out there right now, and we've ultimately been able to leverage our operating model of select service properties in a way that's allowed us to remain open at all of our properties, with the exception of one hotel that we ultimately closed for a brief period of time in April, our Carolina Beach Courtyard, which government mandated us to close. We've since reopened that property, and it's actually one of our better performing hotels, given its leisure demand, drive to nature of the property. But by and large, we've been able to limit our staffing models at each of our properties to support the low occupancy modes that we're in, and in markets that we have multiple properties, we've been able to cluster those hotels. So in markets such as Cape Canaveral, Florida, which we own three hotels, Homewood Suites and a combo Hampton Inn and Home 2 portfolio, we've been able to essentially flex the inventory of rooms based on the demand in the market. So when we opened up the combo property, the Home 2 Hampton Inn, in early April, we actually opened, but we're just accepting reservations and pushing those to the Homewood Suites. Because of the shuttle launch that occurred last weekend, demand picked up. We were able to flex our inventory, open up the combo hotel, as well as the Homewood Suites, and drove really good occupancies during that period of time. And we have other markets that we've been able to cluster and do that same strategy, where we've been able to flex essentially based on what the demand is generating in the particular market.
So let's move on. Let me talk about if you've seen any difference, not necessarily amongst brands from the operations and not necessarily amongst brands, but from the chain scale, from the product type. Have you seen any improvement from, extended stay? We're hearing a lot is extended stay is doing better than your daily ones, suburban doing better than urban, that kind of stuff. Any tendencies you can share with us?
Yeah, I think all of those points are accurate at this point. Our portfolio mix is roughly 33% extended stay. Those properties have been outperforming on a relative basis our other assets, but really we feel as though we're poised to benefit disproportionately to some of our full service peers, just given the fact that we're in a select service box that has fewer rooms to fill, has a more lean operating model, and historically has led and paved the way through a recovery. What we're seeing is a preference towards the value proposition that brands like Hilton and Marriott offer through their guests, and really a desire to look at the extra space that an extended stay hotel might offer, or the fact that with restaurants closed or limited access to restaurants, the ability to cook in room, all of those things I think are leading to an outperformance on the extended stay side at this point in time.
Yeah, again, right in line with things that we're hearing. Are you seeing any difference in the markets? Suburban, urban, and dare I ask what your best property is? You told us the closed down hotel, so maybe that was the worst property performer through this. But any trends there?
Yeah, I think what we're seeing right now is suburban is outperforming urban at this point. Roughly 80% of our portfolio falls outside of the urban core markets, and we're seeing on a relative basis an outperformance on suburban assets versus urban core properties, and really those drive to leisure type markets are doing well in states that have relaxed some of their travel restrictions. So if you look at kind of the Sun Belt market, Sun Belt states right now are in general doing better than other states, and that's in large part one because of some of the government restrictions being lifted, but also many of those states just haven't been as hard hit as others within the pandemic.
Move on. Let's talk the financial side of this piece, this industry, because I think that's a really big piece. Dare I say the debt and the equity.
Right.
The questions that everyone's asking now, right? Especially looking at publicly traded companies, but okay, all companies. There's liquidity, and then there's solvency, right? So you guys currently have $1.5 billion worth of debt across all lines, and you just pulled down on your $425 million on your revolver. So you've got that in cash. Let's start with the debt. Are your lenders working with you? I'm assuming by the nature of whom you are, you're having better conversations than maybe the guy out there with one or two properties, but maybe not because it's CMBS. So what kind of dialogue and success are you having with your lenders?
Yeah, I think by and large, the lenders have been good to work with thus far. A big differentiator for us is the fact that of our 233 hotels, only 31 of them have CMBS debt on them at this point in time. So, historically, we've taken a very conservative approach to the leverage that we were willing to put on our portfolio, and really wanted to maximize the flexibility of our balance sheet to help create stability in all cycles. And so that's helped in those conversations. The fact that we just don't have as many encumbered assets it certainly helped. As we've had our conversations, as of the end of at the end of the quarter, we were up to date on all of our payments, and we hadn't tripped any of our debt covenants. I think that bodes well for our position or our ability to be able to negotiate and modify some of the debt covenants that we have, and we're in the process of doing that right now. And you've seen other public REITs come out with their debt terms. I would anticipate that we would be in a similar position as they are in terms of what type of relief we'll be receiving in the near term.
Yeah, you mentioned your low leverage position, and my numbers show compared to your competitors, you guys are 58% liability to gross asset value, and which is pretty close to industry low. And some of the other guys on the high end are 90, 95, 97, 98% leverage. So you guys are in a really good position there.
Yeah, if you look going into pre-COVID, we were like just over 3 times debt to EBITDA, and so really, as and that's the metric we focus on the most. But that was historically one of the best in class among all of our peers in the full service and select service realm, and that really has positioned us and differentiates us from a lot of our peers on several fronts. But more importantly, as we look to what it means and how quickly groups and individuals can become cash positive, debt coverage is a big component of that, right? And the fact that we have a lower debt ratio compared to our peers, and the fact that we're diversified across, you mentioned it, 87 different markets in 34 states, and have a scaled portfolio, we anticipate that we'll be able to achieve that break even and ultimately a cash flow positive, that we'll be able to achieve that quicker than some of our peers.
So obviously, it's assuming you, like everyone, is not cash flow positive today. So hitting on the solvency, what's your burn rate currently look like? And therefore, how long do you think you can make it? I'm sure you're doing a lot of math around it right now. So what does that look like, if you can share?
Yeah, it's an interesting question, and yeah, the first several weeks of the crisis, it was all hands on deck trying to determine what our true cash burn is going to be. And we have some good numbers coming out of April, and ultimately we'll have numbers coming out of May that will help refine it over time. But as we've looked at our cash burn right now, we anticipate that we're somewhere in the 18 million a month, assuming a very low occupancy level. So that would be like 15 to 20% occupancy. Within those parameters, we would be roughly 18 million a month on a cash burn basis, recognizing at the end of the quarter, we had 437 million pulled down in cash, and we believe that we have a runway sufficient enough to allow us to weather this storm and get ultimately back to solvency.
So I'm trying to do quick math in my head. You're looking at 20 plus months you can survive at that burn rate. Is that right?
Yeah, and we haven't officially published anything, but a lot of our peers have put out numbers in that range. It's not a linear progression, so it's really difficult to calculate, right? So as occupancies return, your F&B may change slightly, but again, we feel, given what we know today, that we have more than enough in cash to cover our needs in the near term and hopefully weather the storm, just given what current trend lines are.
And I'm assuming, I'd love to see what your models look like. Most everyone we're seeing, right, lows in the 10%, then up to 15% occupancy, 18, 20, 22, now maybe even 25% occupancy. I'm assuming your portfolio is trending along those same lines.
Yeah.
I'm curious to see what your outlook look like for the future. Dare I ask, what did Memorial Day look like?
Yeah, so as we looked at our portfolio, January, February, we were tracking very much in line with our expectations and our guidance. March, beginning was okay. The end, ultimately, when COVID hit and we saw the NBA close its doors and all these other groups began pulling back, I think it was a shock and awe for a period of time, and really we were trying to figure what we can, how we should address the COVID crisis. But at our low point to date, we were 15% occupancy, and that was in early to mid-April. We've been slowly but steadily climbing occupancy since that time. And Memorial Day weekend, for the week of May 23rd, we were at 31%. And so you can see that trend line from 15 to 31. And really that trend line has continued in the subsequent week in terms of continued growth in occupancy on the margin. I mean, it's baby steps right now, but it's at least positive.
No, it's great news. That's great news. I can't believe that I just said 31% occupancy is great news, but new normal. So I think it was great news. So let's talk a little bit of the offense strategy. Any chance with the $437 million in cash you got that we're going to find some opportunities and buy some assets, or we're not there yet? We got to hold it to make sure we can pay the bills.
Yeah, I think as I look at it, I think a few things need to happen. First is becoming cash flow positive. So as we're looking, cash preservation is important to us, and so becoming cash flow positive is an important component. And I think for the items I've outlined, the fact that we have a lower debt ratio and debt payments, as well as being able to spread some of our G&A costs across a broader portfolio, I think we're going to hit that profitability a lot sooner than some of our peers. And at that point, I think you'll begin to see us look to refine our portfolio similar to what we've done historically. So this year, prior to COVID, we had sold 2 assets. You had helped us sell one of those assets, so appreciate that. And we had bought 2 additional hotels. And so we were refining that portfolio. And I think what you'll see in the early stages of the recovery is first a desire for us to become cash positive, and then a refinement, a pruning of sorts of our portfolio. And then ultimately, should the capital markets come back, the desire and ability to grow at that point.
So let's talk the sell side. I think, dare I say, for all the buyers that are out there saying, when is Apple going to sell me something? When do you see that happening? And maybe you're just reallocation of dollars within your portfolio, but when do you see that happening?
I think for us, what I would like to see prior to us looking at any meaningful transactions on the sales side is a shrinking of the bid-ask spread. So as I look at it right now, we're kind of at the widest point, if not, maybe that was a week ago, and it's slowly getting a little bit narrower as more information, more data is coming out. We have a better understanding of what it's going to cost to carry these properties in the near term and how quickly they're going to come to profitability. For us, where we're low levered, we're broadly diversified, we have the ability to weather the storm for a period of time. We are only going to be opportunistic on disposing of assets to the extent that it ends up providing value ultimately to our shareholders.
I think you're right, and I'll say it so that I was going to ask, what do you think the bid-ask spread looks like right now? Maybe
Yeah.
I will ask, and then I'll answer for you.
You see it as much as I do, but it's wide. We're not, and I think because it's as wide as it is, we're not seeing a lot of transactions right now. And I think the frozen debt markets are also playing a big part in the fact that we're just not seeing a lot of transaction at this point. But yeah, I mean, we certainly fielded a number of calls on the front end of the crisis that were very opportunistic in nature in terms of how they would value particular assets. And we're just not there right now. We have we believe in the core product that we own. We believe the select service and extended stay model are going to lead the recovery, and I think we're positioned well to have, relative to other asset groups in our space, a quicker recovery.
From a transaction standpoint, just stats, in March, there were 88 deals, hotel deals across the entire spectrum. In April, there were 8. And in May, I think I saw 11.
Right.
Well, biasly, we closed one last week. It was a deal under contract pre-COVID that all but died, and without a retrade, but kept it alive, and it closed last week.
Right.
So there are some getting done.
Yeah, there's some getting done, and the groups that focus on getting to that finish line, I think can get there. We're still receiving reverse inquiries on a number of our assets, and we're exploring opportunities. But it's become increasingly more challenging to underwrite dispositions in today's environment, and I do believe over time that's going to improve as the debt markets return and as we get further into this recovery, where we have a better understanding of what the operational implications are going to be at these low occupancy levels.
All right, let me see if I can't make you uncomfortable. Let's talk about your stock price. Sure. So pre-COVID, you were, I don't know, $16 in January-ish, February, up to a low of $4.48. Currently trading $11.60, if I checked this morning.
Right.
I won't ask if feel like you're overvalued right now, running 31% occupancy. But how do you feel about your stock price today?
Yeah, I think as I look at it, it's been choppy for the last several months, right? As the market has tried to factor what COVID really means. If you look at it, from where we're trading today to where we were trading pre-COVID, that represents roughly a 30% discount. You're not necessarily seeing individual assets trade at that discount today. And we've had a number of our analysts come out favorably on our business model, and with price targets that are above where we're trading today. And so I think where the market looks is forward. And if you look and believe in the business model that we are, the select service, broadly geographically diversified, a healthier balance sheet than the majority of our peers, and the ability to weather that storm, and the fact that leisure and business transient is going to lead and pave the way out of this recovery most likely before other large box group type convention business, then I think that supports some of the reasons why we might be trading where we are.
So you guys, like everyone, have suspended dividend. When do you see that coming back?
Yeah, on the dividend, out of an abundance of caution, we pay a monthly dividend, and we suspended our dividend similar to all of our corporate peers. For us, I think what we want to first see is being cash flow positive. That's an important component. And at that point, I think we'll reassess what our dividend policy um, and metrics will be. But for us first, cash flow positives is an important component.
So talk about how you see the recovery, and maybe ask what you're modeling. And is it 2023, 22, 24? When are you seeing that full back, full RevPAR?
I mean, your crystal ball is as good as mine. I think most industry experts are anticipating a prolonged recovery, and I think looking at our portfolio and how it's positioned relative to some of the bigger boxes, I think we'll outperform those through the recovery. But I believe it's going to be more of an extended recovery at this point in time.
I love it, Nelson. This has been great. I'd love to get you back to Atlanta and go to a Hawks game.
Yeah, me too.
I don't know when we're going to get to do
Those
that,
were the
but
days.
I keep asking
Yeah,
Ben, when do we get to go back?
Yeah,
But
we need to put some pressure on him.
somebody get some influence. I appreciate you coming. It's tough times we're living in, obviously. But with companies like you guys and leaders like yourself, I appreciate you coming on and sharing your thoughts and just what you're seeing, because uncharted times, we got to learn from each other. Yeah. So I don't know when I'll get to see you, but I'm looking forward to it.
Well, and I appreciate you putting these together. It's good to see your face virtually and just to stay informed and connected in the industry. So appreciate it.
Thanks, Nelson. Let's do it again.
All right, bye.